first of all, emerging market asset class is a very large asset class and growing and very diverse. So it spans across more than 80 countries, from large countries like, for example, China, to a very tiny countries like the Caribbean islands. Second, in the world where the interest rates are very low or almost negative in many places, emerging market is one of the last harbors of the yield, okay? Because the yield of the asset class, depending on the segment, it goes from 4% to even 7% at this moment. And finally, it offers very compelling risk reward, but of course, you need to go with the experienced EMD manager to get these opportunities in the asset class. Yes, we talk about the returns. Of course, investing in emerging markets is also about managing and understanding the risk. So what makes us well positioned for that is our heritage in emerging market. We've been doing that since the beginning of the asset class for the last 27 years. And this is in our DNA of the NNIP. Second, our proven investment process that has worked over time and different moments of the cycle, and our global team, we are very well positioned to capture these opportunities in the asset class. And last but not least, which is the sign of times, we have been focusing a lot on the integration of ESG factors into our investment process. ESG is all but the fading fashion. Actually, it's getting a prominence everywhere in the investment world. The asset owners, the clients, they require their asset managers to incorporate ESG into the investment process. The COVID crisis that we are dealing with has just accelerated these processes, and it's very likely that the rebuild of the planet past this crisis will take the green tilt, and this will bring the ESG theme towards the emerging market. And I think what is important specifically for emerging market is that we should just not take the developed market framework and apply that bluntly in the emerging market. We need to create a separate, specific framework that will capture the unique aspects, unique characteristics of emerging markets. Like, for example, a low starting point of many of those countries, or the data problems, or the fact that most commonly used frameworks are very much backward looking. We need to create something which will be well suited for investing in emerging markets. Of course, looking at the history, the G factor, the governance factor, was the biggest driver of the asset prices in emerging market, and was also had the biggest explanatory power when it comes to the country spreads, for example. However, we believe that indeed the world is changing, and the economic and social factors, environmental and social factors, they will have the increasing influence for the investment in the emerging markets and also for the developed markets. Clearly, the COVID crisis has shown that there is a lot of focus on how the societies, how coherent socially they are dealing with the virus. Second, the regulatory push will make some help that will be granted to the countries, the most affected countries. This help, the multilateral help, will have this kind of green conditionality very likely attached to it, which was not in the past. And last but not least, the investors, they are engaging more and more with the sovereigns also around the issues of the environment and social factors. Like to give the example, our engagement with the government of Brazil, or governments of the Indonesia, which goes around the environmental issues like the deforestation. This will create a dynamic on its own. And last but not least, the green bond issuance. Many of these countries can consider issuing green bonds, which will diversify their investor base. Looking fundamentally, of course, we cannot ignore the superior growth rebound in China, but also in the countries that have been affected on the growth side this year. Mexico stands out as the country that didn't use too much of the fiscal stimulus this year, which bodes well for the next years. Also should win Mexico from the Biden administration and their focus on the regional approach. On the other side of the spectrum is Turkey, which for years of unorthodox policy has run out of the typical cushions like foreign exchange reserves. However, there are some signs of the return of the orthodoxy here, so early days, but something to observe. We see the incoming Biden administration as a positive for emerging markets for the three main reasons. First, more of the multilateral approach from the US administration, more support for the international organization like the IMF, and also more predictable policy making, which is good for the risky assets. Some countries will be winning from the Biden administration, and some will be challenged, especially on the environmental agenda, like Brazil. On the vaccine, of course, a lot will depend on the speed of the application to the population in emerging markets. And with that, the latest news of some vaccines being easier logistically to transport and keep, that should also open some room for the return of the emerging market growth. First, 2021 will be the return of the global growth, both in emerging and in developed. Second, the monetary conditions will remain very accommodative and global liquidity will remain ample. And third, emerging market offers a very attractive yield and investors are still both under-allocated strategically to emerging market, but also cautiously positioning for a year like a crisis. And if the crisis evaporates, they have the money to deploy into emerging markets. Well, that of course depends on what is the reason for the US Treasury yields moving up, something which we indeed saw. If they are moving because the growth is returning, I think this is generally a positive for the risky assets, and emerging market debt has an ample room to accommodate that kind of rising yield in the US Treasuries with the spread emerging market offers. Of course, we are all remembering the taper tantrum when the US Treasury yields have moved up because of the withdrawal of the liquidity. That is something we don't expect for the next year. So we think the emerging market will not be affected by the rise of the Treasury yields. Well, certainly 2021 would be a very exciting year for all of us, and we're looking forward to that. We have a very large team of 25 investment professionals in our emerging market debt team. We have seen a very strong flows into our strategies over the recent months that allowed, for example, our hard currency flagship strategy to cross the milestone of $6 billion assets under management, and the overall assets that the team is managing, they are now above 16 billion, which is quite a decent jump from the recent months. So we believe we are well prepared to capture the opportunities that the next year will bring, and then we are keeping the fingers crossed, and we want to take our clients on that journey with us.